event. Our 17th annual was a hedge fund panel in 1984. It's now an alternatives panel since other alternatives have gotten some prominence, notably precious metals, private equity, which we've had some in the past, non-traded REITs, but I'm a rather skeptical investor, so this year all of our panelists have CFA charters, so they have what type of duty? A fiduciary duty. So do they give us their best efforts? Always. We know that they have the smarts, the knowledge, and the persistence to get their charter, and that they will fight for their shareholders as well. So we have 4 panelists that made it through. One panelist had to go to Europe unexpectedly and couldn't make it this year, but was with us last year. Ali Mohammed. Tonight's first new panelist is Sumit Gautam. And Sumit, along with a couple of other panelists, was a summa cum laude graduate in college and graduate school. Number 2 in his class at the Indian Institutes of Technology. And he has the CFA charter and also the MBA at a famous university. Sumit manages the Scalar Gauge Fund, of which you'll hear a bit more later. But he is somewhat idiosyncratic, coming up with unique investments, and hedges by being short things that are considered less attractive. Our second panelist is Garrett Goggin, CFA, CMT. Garrett has been on the board for a few years. He's our treasurer, an important position. And he is senior editor at the Gold Stock Analyst and has followed the gold mining industry for a decade or more. They have a famous event that they put on in Fort Lauderdale every year. And guess what time of year it is that they put it on? My guess is February, and I was right. And then there's one in Denver that they just had a month or so ago for the gold bugs. I've always been interested in gold, and the one movie that every CFA charter holder should see is Treasure of the Sierra Madre. Won a bunch of Academy Awards, 1949, Humphrey Bogart. John Huston directed it. His father, Walter Huston, won an Academy Award, and it's really about gold lust, significance of wealth, and what it's like out there in the mountains of Mexico. And then joining us again is Tom Krasner, who was a member and I think got his charter back when he was a member here, when we were all one great big society in South Florida. And he's a past president of the Miami Society. And he's co-founder and principal at Concise Capital Management, where, as he'll tell you, he has worked in high yield fixed income, typically with less known companies where there are value elements. With his fund, he hedges by being short. I think it's IWM, one of the ETFs that is smaller cap. And then we have a new panelist, Paul Korngiebel, CFA, Emerging Markets Long Short at Boston Partners. And he is on their emerging markets equity group, senior person there, but his particular fund is long short. He's got a Phi Beta Kappa from Bowdoin. Does everyone know Bowdoin? Famous college in Maine, Bowdoin. An MA degree from Harvard and St. John's College, and an MBA degree from Northwestern, BSG. I don't know if that's like OMB or not. And then we're also pleased to have, for the 16th year in a row, our moderator of the panel discussion, because he is unparalleled and experienced, twice the president of the New York Society of Security Analysts, and currently with Stuyvesant Partners in New York, and Vinnie Catalano, CFA. So let me bring our first panelist up. We're going to have Garrett go first on gold because he has a presentation.
Hi, everybody. So does anyone hold any gold investments out there, like the GLD? Anyone own the GDX? Anyone own individual gold stocks? Okay, so a little bit of GLD, a little bit of GDX. I've been working with gold stock analysts for close to 10 years. We're solely focused on the gold and silver mine industry. It's a good product because of the research we do, but also because people are interested. You mentioned gold to people. People immediately have a reaction. It's either they love it or they hate it. There's really no in between. It's not like copper or zinc where people just don't have a feel like the base metals. And then recently, gold stock analysts, we just got bought out by Stansberry Research. Has anyone heard of Stansberry Research out there? Yeah, Phil? A couple other people. There's been a lot of things going on with research industry and investment banking. The whole MIFID standard is splitting research away from investment banking. And in Europe, it's actually split. And what is going on right now is it's hard to find good research over there because it's hard to monetize research without investment banking due to the close relationship with strong buys associated with debt deals and equity deals. Stansberry's found a way to monetize it. It's heavily marketing, but they have a lot of good products. They recently also bought out Whitney Tilson. And, I'm sure you've all heard of Whitney Tilson. He ran a hedge fund for close to 10 years. His performance wasn't great, but he's a really good writer. He's a really good presenter. He's a well thought out individual. And then have people heard of Joel Littman? Have you? Yeah. I haven't heard of him before, but he's out of Boston. I'm originally from Boston. And he does what's that?
He's from the Philippines.
Philippines. Oh, okay. I don't know if it's the same guy. But he writes altimetry. And what they do is they take companies' financial statements that are basically GAAP standard and brings them back into uniform accounting in order to find, basically discrepancies and positive discrepancies. And he's had some really amazing picks throughout the years. It's interesting research. One of the things that separates gold stock analysts from a lot of our other competitors is we have an audited track record. We use the guy Michael Holtzapfel at Alpha Verification Service in Charlottesville, Virginia. He's a CFA also, and he does GIPS compliance. Our track record is not total, GIPS compliant, but it's an audited testament that he goes over every year. And as you can see, we beat our benchmarks, gold and the XAU index, and we beat the S&P all the way back from 2001. A lot of the other research newsletter guys out there, they'll throw picks at you. They'll throw 30, 40 picks at you, and they'll take the 2 or 3 that did well, and that's all you hear about all the next year is how good they did. But all of our buys and all of our sells, the whole portfolio is included in this audit every single year. Now, regarding the economy and why gold is a decent place to be right now is because gold does well when stocks and bonds do not do well. It's very simple. You look at guys like Ray Dalio with the All-Weather Fund and the Pure Alpha Fund, and those funds were basically stocks, bonds, and gold. When stocks and bonds went down, the gold part of the portfolio did very well and made up the losses. You can see here negative yield curve inversion back in 2001. Whoops, that's not the right one. Back in 2001, and it occurred in 2007, and it just occurred now. Now the curve is steepening. So, we're starting to, basically the curve is becoming uninverted, and then what's happened after the curve started steepening back in 2000 is that the S&P went down close to 50%, and it happened again in 2007. And rates also went up tremendously, which means bonds went down. So it's a simple story. Yield curve inversion, recession, Stocks and bonds don't do well, gold does well. That's the way we look at it. In 2001 and 2007, gold doubled over the next 3 to 4 years. Now, why smart investors don't buy gold stocks? If you take a look at this chart, it's core mining. Are people familiar with core mining out there? It's one of the largest silver producers. It's a big company for the mining industry. It's I think like a $3 billion market cap. If you look at the performance this year, it looks pretty good. It's up 53%. It's beating its GDX benchmark, which is only up 25%. However, you take a step back, look at the longer term performance from 1984. Core mining was trading at $300 a share. This is split adjusted, because what happens is they do dilutive deals, the stock goes down, they continue doing dilutive deals, they roll the shares back, and then the share prices appear to be much higher back in the past. But this chart is the same thing as a triple leveraged VIX ETF. It's just an absolute capital destroyer. And a lot of the companies in the mining industry are run like this. And to be honest with you, it's like, I don't understand why this is illegal, or these CEOs are replaced. A lot of them are, but some of them are still managing their companies that way, just doing tremendously unaccretive deals. This is Endeavor Mining. You can take a look at their share count. Very basically, share count, it's very closely correlated with dilution. Its share count went from basically 10 million shares out to over 100 million shares over the span of 15 years. And this is an adjusted ratio also. It probably had 100 million shares out back then, and due to all of the reverse splits, it would be more. It's just not good for shareholders. Now, one of the reasons why these companies continue to operate, and I don't understand why or who buys these things, but core mining, you look at the buy-sell recommendations. Core mining's got 5 buys and 4 holds, and it's not good for shareholders. But you know what? It's good for the investment bankers, because they do a lot of debt deals and they do a lot of equity deals, and shareholders get screwed, and the banks make a ton of money. Now, this is an interesting slide. This is one of the main reasons. It just shows the capital destruction in the industry. Companies Kinross Gold, they paid $7 billion for this company, Redback Mining, back in 2010 for 2 deposits, Tassius and Chirano. So they paid $7 billion, and then they've never been able to really get it going. And if you look at, now they have an estimate out, a new feasibility where they need to spend another $150 million. This is cut back from $1 billion plan that they had. So they spent $7 billion, they got to spend another $150 million. You look at their production last year, their free cash flow, they lost $267 million running these 2 projects in 2018. And they've owned them since 2011, and they've basically done that every year. And you look at these financial statements, there's a thing in the mining industry called all-in sustaining costs. You've got cash costs, which don't include CapEx. And then the mining industry smartened up, because smart investors are saying, hey, you got to look at CapEx. So they developed a standard called all-in sustaining cost, AISC. And Kinross doesn't even report it on a mine-to-mine basis. You got to figure it out yourself. And when you do figure it out, their mining cost is $1,805 an ounce, which is ridiculous, which means they're losing $600, well, back in, or whatever, $500 for every ounce that they mine. And they just destroyed $10 billion of investor capital. And this is one of the large companies out there. And it's funny because, like, you look at their annual reports right here, that was on their cover, their annual report. Strength, discipline, excellence, their strength, unaccretive spending, undisciplined, and they're excellent in capital destruction. So that pretty much sums it up. And that's what a good analyst can add to the industry, because the CEOs of these companies, and most companies, they're professional liars. They're never going to tell you the bad thing, and they're always going to only tell you the good things. So it's a good analyst to figure out the good and figure out the bad points in order to value the company correctly. Now, not all the mining industry is bad. A vast majority of it is bad. There are value creators in the industry. The royalty companies, Franco-Nevada, Wheaton Precious, Royal Gold, Sandstone Gold. The GDX, the benchmark, is the blue line down the bottom, and all the royalties are in the colored above. And they've all outperformed the GDX benchmark, which is out of the mine industry, not including the royal industries, you can count the companies, the producers that outperform the GDX on one hand. There's probably 4 of them. It was Randgold that got bought out by Barrick, and then Agnico Eagle, which is still public right now, and that is a good opportunity. But other than that, it's the streamers that beat it. So if you're interested in the gold mining industry, you want a gold allocation, it's probably GLD would be an easy buy. Franco-Nevada is the biggest blue chip in the industry that's consistently outperformed the market. And the reason why these royalty companies outperform is because they buy streams. They buy 3% of a production from a mine. And they pay a lump sum up front, and they pay an ongoing fee. But these mines go on for 10, 20, 30 years. So that 100 mil that they paid for it, 10 years ago, over time, they're getting a lot more gold for it. It becomes a lot more valuable. And they also have, hundreds of streams. Franco has, I think, 160 streams. So if one mine runs into trouble, the other 159 streams would do well. It's not a big deal in their portfolio. These companies do well. I think this is close to my last slide, but one of the other ways you can make money in the sector is special situations. The GDX basically dominates the industry. The mining sector gold mining sector is pretty small. All the portfolio managers are benchmarked to the GDX. So what happens is they don't buy companies that are not in the GDX. Now this company, Silvercrest Metals, got spun out of Silvercrest Mines that was bought up by First Majestic that we owned actually, and they spun out Silvercrest Metals, and what happened was none of the portfolio managers could hold it because it wasn't in the GDX, so they sold this stub, and it was back at 11 cents, and they sold it, and now the company is at close to $6 a share. That's a 5,000% return. I ended up adding it to the portfolio around 2. I needed to get my mind around it. But you can find some opportunities there, but you really got to know what you're doing. This is some of the gold stock analyst research, all the companies we cover, and then we calculate an average cash cost and all-in sustaining cost. That you can see 663 cash cost, 894 all-in sustaining cost. And using that cash cost, we're able to calculate an average operating cash flow every quarter all the way back to 2006. We can compare that to the HUI index, which is a gold mining index, and you can see the tight correlation. It's tight. It's 98%. But the correlation broke in looks like 2017, where the operating cash flow margin, it's just the price of gold, which is $1,500, minus the cash cost, which is around $600. So you get a $900 margin. That's a healthy margin, like 55% right here. So based off this, the HUI index is undervalued by 40 to 50%. I like looking at stuff like this much better than a simple gold GDX, because it doesn't include margins. As gold goes up, the prices go up. So the margins are more important to me. And lastly, a 10x free cash flow to the firm multiple. You can basically strip out all the corporate expenses because if a larger company is interested in a smaller company, they can take it over. They get all the free cash flow from the mine, and they fire all the management, and they close down their accounting office and stuff like that, and the parent will take it over. So you can look at just free cash flow to the firm, and 10x is a good multiple. And in order to figure out that free cash flow for any gold company, it's just revenue minus operating expenses minus the sustaining capex. So it's basically 3 numbers, and you can calculate that. You multiply that times 10. That is basically the fair valuation for all the gold stocks out there. So you're looking for them. You're looking for companies that are trading for below that. And You know, that's Silver Stands is one of the projects that I follow. This is just one of my NAV calculations, and it's simple NAV and it's simple IRR in order to forecast the value of a project. So, you know, gold mining is not rocket science. It's mining rocks and crushing rocks and, you know, washing rocks, and that's it. And, you know, it's a simple industry. One of the Randgold, Mark Bristow, that now runs Barrick, did a great job, and he had simple metrics for running the company. It was, you know, use $1,000 gold to value your projects and only invest in projects that give you a 15% IRR. And that is a very simple story. And if you're like, if he was doing that, then what were the other companies doing? You know, it was frightening that they were just adding unprofitable ounces, you know, on top of unprofitable ounces. But, you know, there are good companies out there, and we provide a good research product. And gold does well when stocks and bonds don't do well, and it reduces the standard deviation and gives your portfolio a better Sharpe ratio. So that's it. Thank you.
Hi, I'm Vinny Catalano. Thank you all for being here this evening. This is going to be really an exciting discussion. As every one of these that I've been privileged to be a part of over the past 16 years, every single one of these alternative investment panel discussions has always left us with information that has been really quite useful. And it's always been different. It's always been covering different areas, et cetera. And tonight is going to be really rather unique in terms of some of the subject areas that we're going to be exploring. What I would like to do is ask our panelists to please come up and sit in the Oprah setting that we have over here. And I'll give you a little bit of a description of what we are going to cover this evening. Sumit, you also can join us, please. Okay, and Tom? Is Tom around? There we go. Okay. This part of the program is all Q&A. I ask questions for a while, you ask questions for a while, and then we turn it over to our panelists to give us a closing comment. The closing comment can be something that we discussed, didn't discuss, they're working on, they're not working on. That's the only segment that is in their control. Everything else is in our control. My questions tend to be a single question with a follow-up per person until we've covered everybody, and then circle around for each one of the panelists, and then I turn to you for questions. So please do think of questions that you would have in mind for our panelists. My approach is to set the stage and cover several of the key areas, and then to allow the opportunity for us to explore, for you to explore any particular area a little bit more in depth. So with that, we're going to start off with asking our panelists, let's see here, if we can go from the outside in, and I'll ask each panelist to briefly give us a description of themselves, their firm, what they do, and that sort of thing, and then we'll get into the Q&A segment. So, Sumit, you're first up.
Good evening. My name is Sumit Gautam. I run a fund called Scalar Gauge. We're based out of Dallas. I started the fund about 2.5 years ago. We do long-short equity with low net and low gross exposures. We have generated significant alpha in this time frame, have been able to catch up to the indices while being able to prevent the drawdowns that had happened in the markets over the last 2 years. So for example, in Q4 of last year, as the markets were down 13% or so, we were relatively flat, which is one of the propositions that we have. We focus on idiosyncratic opportunities, mostly focusing on small to mid-cap, US-based companies, average market cap between $1 billion to about $5 billion. The two big things that are different about us, number one is that we are idiosyncratic, so the names that we own are going to provide very low correlation with the market. In fact, our correlation in the market is about 0.3. The second important aspect is that we are private equity approach to investing. Essentially what that does is that we identify intrinsic worth for our companies. We have had 12 of our long companies being bought in the last 2 years, mostly by private equity. So that serves as a good baseline for us. And I'll be happy to answer other questions. Thank you.
Thank you, Sumit. And by the way, Sumit did provide, for many of us at your place setting, some information in regards to his fund. Thank you. Paul?
Hi, I'm Paul Korngiebel. I'm with Boston Partners. At Boston Partners, we manage roughly $90 billion. I'm about 80 domestically, 10 billion internationally. I run our emerging market strategies. In particular, I run emerging market long short, which is on our liquid alts platform. The emerging markets long short fund is a pretty unique product. There used to be a competitor or two in the space, but it's something that's tricky to do. You need an industrial scale back office. You need to do a lot of shorting on swap, and to offset the shorts, you need longs on swap. So you really actually need a lot of expert plumbing to do the strategy. So we're first out there with the strategy. We've been doing it for about 5 years. The results are pretty good. Two of my colleagues here, Paul Heathwood and Chris Fialbo, I'm sure if you give them a card, they'll send you some information about product descriptions, what we're doing, pitch books. So whatever data you need, feel free to ring us up. What's fun about the product, it's essentially taking what we call our three-circle process, which are the super factors of value, momentum, and quality. We call it fundamentals, into the world's least efficient markets. So we've been deploying this strategy in the United States successfully. Our U.S. business is pretty much on close or soft close across all the products. And so just to continue growing, we've consistently moved outside. And this is the place where our quantitative model has the biggest spreads. This is the place where our fundamental analysts come back and say, oh my God, I can't believe it's this cheap, or it has these characteristics. We never see this elsewhere. So it's been a very fun process to be on something very innovative, and also being supported by a very large organization.
Terrific. Tom?
Tom Krasner, Concise Capital. We're down in Miami. I co-founded the shop back in 2004. We've grown it up to about 350 million right now across a variety of distribution vehicles, all in one strategy. For the offshore market, we have UCITS funds, separate accounts, hedge fund, we're a sub-advisor to a mutual fund, et cetera. The strategy focuses on a small part of the high yield market. Specifically, we focus on short duration, smaller issue, high yield bonds. Short duration is we're right now running about a 1.6 year duration, and that has a bunch of advantages and lower volatility. The second part of the strategy is looking at small issues. And by small issues, most bonds out there in the high yield world are 500 million pushing $1 billion in issue size. Our average issue size is about 200 million. The reason for that is high yield is an over-the-counter market, and these smaller issues pay a liquidity premium. And our strategy, to keep things simple, is to capture that liquidity premium and to have lower volatility via being in short duration. We avoid interest rate risk, and what we really have to watch is default risk. We also hedge the portfolio to reduce volatility of the long position. And we've been doing this for quite a while now. And how many panels have I been on now, Vinny?
A few.
A few. All right. I'll pass it on to Garrett, who you've already met.
Yep. Good. Garrett, please.
Yeah, I'm good.
Okay, you're here. All right, very good. Tom, if we could focus just a little bit on the high yield market for a moment and interest rates in general. Okay. Garrett had referenced negative yields in his presentation. Does your firm have any views on where interest rates are at now, and how does that play into your decision-making and finding opportunities? Give us some sense of your thinking in that, please.
Well, I'll answer the interest rate one, and I'm going to plagiarize a speaker we had at CFA Miami about a week ago, or 2 weeks ago. I think, Chris, you were there, and you might remember he quoted a Fed governor about interest rates. And I think it was the governor at the St. Louis Fed. I don't remember the governor's name. And Bullard, okay. And Governor Bullard is asked frequently, which way are interest rates going? And his answer is, well, they're going to go up, and then they're going to go down. Or they might go down first and then go up. That's my answer on where interest rates are going, Vinny. I'm sorry I can't do anything, but to use the saying, I'd be on my yacht if I had any insights there.
Okay.
The high yield market has had a great year. The indices are up over 11%. We follow a benchmark called the HYS, which is short duration high yield. That's up over 8%. But it's been a market where there's been a huge disparity depending on where you are. If you're in double B, you've been awfully happy. If you've been in long duration, you've been awfully happy because interest rates have, boosted returns. If you're in large issues and all the new money is flowing into ETFs, you're very happy. But if you're in places like CCC, you're not so happy. CCC is only up 5% this year as opposed to 11% for the broad index. I think the long duration high quality is up somewhere maybe around 18 or so. So this has been a year where everyone is scared of the economy, and because they're scared, they're willing to invest in high yield. There aren't a lot of places to put yield or to get yield, but they're also playing it safe. And they're playing it safe by being in double B, by being in higher quality, in larger issues. They're also, a lot depends on what sector you're in also. Retail and energy have sold off. The energy sector is only up about 2.5% this year. It's really suffered. And if you talk to people at natural gas companies or in oil, that spigot is closed. They're not able to raise any money from Wall Street. So a lot of what we're seeing is a huge disparity. This is an unusual disparity. And so going back to where are interest rates going and what do we see for high yield, it depends on the economy. Most people who are following the economy will tell you it's very strong, and there's really no reason specifically to be fearful that we're headed toward a recession. And when everybody's talking about a recession, usually the recession doesn't come. It's usually when people are thinking everything's going great that you actually have the recession. But if you look at other indicators, there are reasons for worry. The inverted yield curve we hear a lot about. Of course, the inverted yield curve usually has inverted at much higher rates than it is right now. We also hear about some overheating in the housing market. We hear about, if you're in the high yield market, I will tell you downgrades by the credit rating agencies versus upgrades are much higher than they were a year ago. So there are reasons for concern, and you're going to have to make a determination as investors which way you feel the economy is going and how do you want to place your bets. If the economy holds, double B is way overbought. CCC has tremendous value, and it should bounce back. If we're headed into a recession or a slowdown, then you'll see a further rise in default rates, and then you have to play it safe.
Before I go to Sumit, just one follow-up with you. Tom, do you see any concerns in regards to downgrades? Usually there's a threshold of downgrades and defaults that say bad things are coming. Are we at those levels, or do we still have a ways to go?
Downgrades are getting worse, but they may, it all depends. I mean, if you look at the energy sector, it's in disarray. There are a lot of downgrades in the weaker names, but that can turn. We're still at a spread of only, I think, 420 basis points. Now, the CCC index is at a spread of almost 1,000. That could be a buy opportunity, or it could be the start of a deterioration. It could go either way. But yes, we are seeing some signs of duress, but those signs could reverse if the economy continues to be strong.
Sure. Sumit, yes.
I had two comments on the description here, and they're related in some ways. I think the first one you mentioned about the disparity that you're seeing in the credit side. And I will say that the same disparity that he's seeing on the credit side, we're seeing on the equity side as well. And that does relate to the fact that economy is not doing great. We have weaknesses across almost all sectors in the economy, and we do a lot of fundamental work, so we're collecting a lot of data, talking to customers and partners of the companies that we're talking to. I talk to probably 5 management teams and a bunch of partners and resellers every day. And the big thing that we're collecting is that because of that weakness in the economy, people don't know where to put the money, but they still have a lot of money. And so in that case of credit, it goes into very high quality credit. And the same way in the equity side, it goes into the so-called safe assets. And of course, with the interest rates going down, there's a lot of liquidity in the market. And so that liquidity has to go somewhere. So the way to think about this is there's supply and demand. Supply of money, which is very high, and the demand from the companies, either equity or the credit side. What that does is that it is creating a huge disparity. So you see companies which are supposedly good quality companies trading at enormous valuations because everybody flocks to them because they are the safe assets. Of course, you've seen that in utilities, you've seen that companies like Procter & Gamble, you've seen that with some of the restaurant stocks, Starbucks and Chipotle and Hershey's, and you've seen it with Apple. And so you see that tremendous amount of money flow into safe names because people are trying to hide there while the rest of the economy is weak. I just wanted to highlight that this disparity is not unique to credit. It's happening in equities as well. I don't know how long it lasts, but we're not seeing much signs that economy is improving. I think the multiples have gone up in the last 6 months or so while the data has deteriorated.
It seems to be a strong reach for yield. Would you say, Sumit, a reach for yield in a lot of cases?
Absolutely.
Yes, Paul.
Yeah, just since I'm usually on the other side of the world, in China, you just got prints around 6%. You know, you can use real, that's GDP. There's activity, sort of synthetic indices to track activity. Maybe it's lower than that, but clearly China's slowing down, affected by the trade war. A lot of stimulus, and we're seeing cuts then across most of the ASEAN regions. The rates tend to be surprisingly low in these parts of the world. If you punch up on your Bloomberg, Thai bonds or so their yield curves they're not quite European, but they're low. The way I'm thinking about it is relative to any other place in the world, the U.S. looks pretty good relatively. What I'm concerned about is what happens with the trade war if it intensifies. That's just slopping off GDP. Like estimates are, it's already up to like 80 basis points off of global GDP. So if that gets worse, that's not good, and could be an exogenous shock that kind of tumbles things over. But December 15th, we'll see about tariffs. The other thing is, even if a deal gets done, we don't know how substantive it's going to be. I'm a little concerned about hitting a pretty good earnings air pocket in maybe Q3 or Q4, because I think people, I hear from our domestic business that there's been delays in CapEx and people are withholding. So again, I think it seems somewhat balanced. It's unfortunately, I think it's probably reasonable that the United States has to at least confront China about IP theft. A long and protracted trade war might not be the best thing for any of us.
Well, stay with China, Paul, for a moment in regards to the area of asset purchases of particularly U.S. debt instruments. Do you see any impacts of coming from the trade war and China, whereby they would maybe purchase fewer Treasury obligations in the U.S., that sort of thing?
Yeah, I haven't. That hasn't really spiked as in the info flow that I get as one of the tools. We saw as early as 2015 some diversification out of U.S. debt into some sort of basket. And I think this basket, this is from memory, so there's some sort of basket they're maintaining for their exposure. I don't think it's in their best interest to start dumping large amounts either. So that's really not a hot spot.
So you're not seeing that then?
Yeah, that's
okay.
Yeah.
You did bring up the I'll call it the E word, exogenous, the exogenous event.
Yeah.
Any sense of that? I mean, by its very nature, who knows?
The Rumsfeldian unknown.
Yeah, it's an unknown, right, exactly.
That's why we hedge.
Exactly, okay. Sumit, did you want to add?
Just a quick point on the China side of it. So number one is that China had been weakening even before the trade war. Point number two, when you think about Europe or other economies around the world, they are not participating in the trade war, but they're still weakening. So there is absolutely a weakening going on across the global economy. I just want to make sure that it's not just trade war is going to get done and we're all going to be back, doing great things. There is some slowdown that's happening even outside of trade war. So that's number one. Probably the second important point to understand is that even if, let's say, we solve the trade war and get it all done, let's say I'm a CEO of a large company and I had a big plant or division I was operating in China. What do you think I'm going to do? Am I going to just say, hey, trade war done, let's go and make new investment in China today? I'm not doing that. And most of the CEOs have already started pulling investments away. So whatever manufacturing capacity you were building, you're going away to other places. In business, things don't happen that fast. And things set in motion, and they stay in motion for a while. My point being that the trade war getting set up or not set up, I don't think that that's going to be a big boost for the world economy, because suddenly that investment is going to come back to China.
Yeah, I would agree with that. I'm just saying we're at least lopping off the worst part of the left-hand tail. And what you're saying about the redoing of supply chains, for example, we were talking with the Singaporean banks. They're setting up divisions to help people move their manufacturing from China to Vietnam or Bangladesh or whatever. So the strategy now in the supply chains that we're seeing is China plus one. That's going to be, it might be a bit fanciful on the U.S. as part. We'll have to police that, since I think people are just shipping things from China to Vietnam and then Vietnam to the U.S. to avoid tariffs and whatnot. So there'll be a lot of skullduggery to try to get around tariffs. But yeah, the golden era of intense globalization is being unwound, and some of the wags call it globalization 0.85.
Right. Can we stay with you for a moment, Paul, in regards to emerging markets? Okay. They have not been among the best performers, certainly vis-a-vis the U.S. Okay.
The U.S. The
The U.S. is sort of like up there on its own.
The last 10 years has been a dream ride in U.S. equities.
Right. Does anybody have any views as to what the implications are of that? That we've got the U.S. marching on up. I know that Garrett might have some thoughts in regards to what that might mean for gold, but anyone else, and before we go to Garrett on that point, does anyone have any views on that issue? Sumit had mentioned before, used the word disparity. I mean, that's almost like the mother of all disparities, is that you have the U.S. doing what it's doing, okay, and then you got the rest of the world more or less kind of in a completely different state of affairs. How long is this sustainable? The thoughts, Paul, Sumit, and maybe Tom?
From my perspective, I mean, managing my own personal wealth and being a fiduciary, you kind of want to be diversified. It's natural that, we see sort of the worst behavior where people start loading into the asset class that's ripping and ripping and ripping, and then they become under-diversified elsewhere. EM, I think, structurally is set up to be a reasonably good asset class. It's diversifying. Growth rates are higher. Obviously, there's huge governance problems in those areas. But if we're talking about bond proxies in the U.S., like the utilities or these consumer staple stocks that have been bid way up, in EM you can get some pretty high-yielding stocks, or you can get things that have better growth for several turns lower, and you're getting diversification in the portfolio. What we do to try to avoid some of the rough ride in EM is we have an industrial size EM short book, and that's taken some of the sting out, and we've been able to participate in EM with a beta of 0.5. So I think the hunt for incremental investment returns is obviously full on in a low interest rate environment. It's being clever and trying to have idiosyncratic strategies where you can bang out better returns without putting unnecessary risk on the books, which is, I think, what I'm hearing from everybody.
Yeah, Sumit, any thoughts?
Totally agree. But I would not view that in any other lens. If you think from the flight to quality aspect of it, it's being evident everywhere, right? So you have the geography's flight to quality. So emerging markets are not the best quality assets, usually speaking, and so when things get tough, then everybody wants to move towards U.S. And the same thing in credit and equity. So I just want to be aware of that there's a continuation of trend here, and I completely agree that the way to make money in this market is to be idiosyncratic. The risks that you have in that sort of thematic trade that's been going on now for the last couple of years is the valuations go crazy for some good quality assets because everybody hides in those good quality assets saying they are good quality. I mean, U.S. is a very good quality asset. It's the best legal system, and the best manager and the quality of people you have here is much better than, generally speaking. I've had a lot of training grounds. And so because of that, you are facing with and increasingly high valuations for those supposedly good quality assets. And that's in the rear view mirror. So going forward, if you thought that buying the same asset at 20 times EBITDA or 30 times EBITDA is going to be the safe return, that's not going to be the case. And that's what I think that the risks of crowding and the risks of thematic trading, the risks of what's been working is the right strategy. I think that I just implore everybody to understand that aspect as to what's been going on, and focus on idiosyncratic returns, and finding really interesting ideas which are not crowded. We just saw in September and probably the second half or last couple of months the unwinding of some of these momentum trades, for example, especially in technology world, where the SaaS multiples, we had Beyond Meat, one of the companies that probably was trading at about 40 times revenue
few months ago, and now it's at 20 times revenue. You know, as a value manager, is that exciting to me now that the stock is down, 40, 50%? Not at all. Right? I mean, you had companies like CrowdStrike, right, went to IPO, and again, trading at enormous multiples, and that unwinding has happened very recently. And all I'm highlighting is that unwinding could continue into other types of asset classes which people don't think as momentum or doesn't think as enough crowded. So just be aware of that aspect.
Right. Now, I want to come back to you on this point here, but I do want to bring Garrett into the discussion in regards to gold. A lot of what it sounds like we're hearing would be very favorable for the kind of hedge, in a way, that gold offers.
Yeah.
Is that a kind of a similar thing in terms of what you're seeing and hearing?
Yeah, no doubt. Gold does well in times of uncertainty, and idiosyncratic risk is uncertainty.
Right.
With gold stock analysts, we don't necessarily make gold forecasts, which is one of the reasons why I enjoy it. We just use the current price of gold, model our companies, try to find the cheap ones. Because what happens is if you start using higher gold prices to create your models and make your forecasts, the worst companies have the highest leverage. Mm-hmm. So you be constantly, investing in the worst companies. And if the price of gold doesn't go up, it's going to be extremely dilutive and those companies are going to go down. So we use the current price of gold. But, in this day and age, if you look back to 2001 when the yield curve was inverted, gold was at $300 an ounce. Over the next 3 to 4 years, it went to $600 an ounce. In 2008, gold was at about 600, and it doubled over the next few years to 1,200. And right now we're at 1,200, 1,500. To be honest, a gold price at $2,500 over the next 5 years, whatever. Mm-hmm. It's not out of the question because it's done it twice before. So
do you get any completely? It's related to this area as the the hedge against uncertainty. You get any information, feel in regards to things like crypto, as far as it drawing money away from gold? Get any sense of that?
Crypto's been fast money. It went from the weed stocks, it went from crypto to the weed stocks, and Canada's up in Canada it was all mining stocks, and then went to weed, then it went to crypto, and now it's kind of shifting back to gold. I don't know. It's just a little idiosyncratic play, but crypto is a little bit esoteric. It's intangible. Mm-hmm. Gold is tangible, and when times get uncertain, you
right, and
need
it
that
has a much longer
to
history and everything else too. On top of all of that, yes. Very good. I want to go to questions from all of you in one moment. I do have the question that I want to present first to Tom and then to both Paul and Sumit in regards to something that I'm hearing. It hasn't been explicitly stated, okay, but it's been referenced. And it's been referenced in the form of things like crowded trades. It's been referenced in the form of things like passive investing. And it's been referenced in the form of things like exchange-traded funds, okay? Idiosyncratic investing is not passive investing. It's not exchange-traded funds. And yet, it seems like you guys are saying, hey, we're seeing a lot of this, ETF, money flow, thematic momentum, I think. I've never heard that phrase before, but that's great. That sort of thing. First with you, Tom. Any sense of that in your work or in any of the material that you see as it references fixed income, and then to both you, Paul, and you, Sumit, in that regard?
Well, there's been huge growth in high-yield exchange-traded funds. But mutual funds tend to correlate with them very highly because they all seem to invest in the same things, which are large securities. And I'm sure you'll hear the same thing about the equity market, as everyone's really chasing the same kind of investments. When we look at our strategy, we look at the overlap between what we buy and what's in the HYS. And the HYS is our benchmark, and the reason we choose it is because it's the longest duration, short duration, high yield ETF. So it's the closest we can come to a benchmark. But there's only about a 6 to 8% overlap between what we own and what's in the HYS. So you're really getting a very different income stream. And where I'm going with this is, if you look at the credit markets, you've seen an enormous explosion of private debt and funding of private debt over the last few years. Perhaps there's too much money going into private debt. But you're seeing, in general, in the asset management industry, and I'm sure all of you are seeing this, a bifurcation between passive strategies, which are attracting a tremendous amount of money because they're so convenient and because they're low cost, such as exchange-traded funds, and to the detriment to active management. But you're also seeing an explosion of niche, idiosyncratic active strategies, like what we do, like what the rest of the panelists do. And these strategies have tremendous value. They have tremendous value because they're not where the crowd is going for investing in ETFs, for investing in other asset classes that are in vogue, but which really don't represent less value, at least in the long term, than the idiosyncratic strategies.
Mm-hmm. Paul and Sumit, thoughts in regards to the whole passive investing ETF world and the idiosyncratic approach that you guys are talking about in the value proposition, frankly, that exists there?
Generally, I think they're complementary. One you can use to put on beta in client accounts, and then if you want to put on alpha, you need to go get somebody who's trying to beat a particular bench. One of the issues I think of this extraordinary expansion that we had is beta. Unthinking beta has been a winning trade, and the indices. The flow into passive could be exacerbating some of this crowding that we're seeing. So crowding, the way I think about crowding, it's like high action poker tables. So if news comes out, it just means the stock's going to break hard in either direction. We use crowding as one of the factors we consider in our short selling system, both domestic, especially domestically. Obviously, anybody who's tried to short domestically over the last decade, it's been pretty tough. So I think there's, you get into certain meetings and people wonder, why should I ever have idiosyncratic risk in my portfolio when the S&P is returning, easy double digits? Well, that doesn't last forever. So I think, again, it's just a question of balance.
Does that concern you? When you hear that kind of thinking?
Well, as a fiduciary, yes. As somebody competing, I kind of like it.
Right, exactly.
Sort of like, well, and there is a limit to this game. I mean, active investors play a massive role in price discovery. Right. Somebody's got to go in there and read the financial statements, put together models, and do the hard work to figure out if things are cheap or dear, and if they've got positive momentum or not.
Right.
And so it's good for pros. It's always been a good game for pros. It's just a much tougher game for pros.
Right.
And it will just keep getting tougher, I would think.
Right. Right. And Sumit, yes.
I think context is very important. So thinking about the last 10 years, of course, coming out of 2008, we've had a very nice bull market. And generally, I think human society and companies and they make progress, and so things generally would go up over time, and valuations generally improve and increase over time. However, that does not mean that you buy the index, which is a combination of thousands of companies, that they all should go up the same amount because each of them are having idiosyncratic elements to it. The way it plays into is the valuations of those companies that the ETFs is in. And I'll give you an example just to bring the point home. So Apple, for example, and I love the company, I love the products. Apple, for example, is probably owned by about 300 ETFs, maybe more. You have about 300 plus managers that own Apple as a stock in varied amount. Of course, Berkshire Hathaway owns Apple in a big amount, and there's probably another 200 ETFs that own Berkshire Hathaway. And then everybody else, in their retail accounts own Apple and own Berkshire Hathaway. And plenty of managers here probably own both Apple and Berkshire Hathaway. And so think about 300 ETFs, right? Plus the 150 that own Berkshire Hathaway. I mean, I'm trying to highlight that there is a lot of money that's chasing some of these names. And because ETFs, as the ETFs get bought, you have a bid for that underlying security. And so Apple goes up. And then everybody who owns Apple feels really good, and then they buy more, and then the ETFs buy more. So it's a great cycle as long as it's continuing. And this is not meant for Apple is not a great company, or I'm not recommending. I'm just trying to think about that. This is what happens when you have tremendous amount of ETFs that own same assets. What we try to do is we try to own companies that are not in many of these ETFs because the game looks really good when it's going up. And sometimes, for example, like we saw many times in the last couple of months, when things don't go good, then you don't know when or how to buy a particular stock. Mm-hmm. So from that angle, we try to own companies that are not in ETFs. For example, one of our companies that we own is a company called Mobile RN, which is a small $600 million company, and there's probably about 30 ETFs that own it. And so from that angle, there's a lot more idiosyncratic nature to it than what we're seeing today in the marketplace. Mm-hmm.
I get a sense that maybe we're asking the wrong question, not this evening, but in general when you watch on the programs and the question about whether we're in a recession, we're not in a recession, not that we're in one, but pointing in that direction and negative yield curves and things of that sort. I'm wondering if there isn't something out there where you guys are describing it, where something about the very structure of the way the market operates and this concentration. And where you just described it, Sumit, is excellent. Berkshire owns, and how many owns Berkshire, and and on and on and on, and it's all piled on top of one another. It's almost like I won't hesitate to use the phrase a pyramid scheme, but it really does have that one thing owns another, owns another, owns another, and they all own. And then if something goes wrong somewhere along the way, maybe we're not looking in the right place in that regard. It's just. Every one of these programs every year brings something up that really is just so fascinating. This is like, wow, I've never thought that. Okay, we have time for questions from you. I barely scratched the surface. You have an MIT grad over here. You want to ask him about artificial intelligence, you can ask him that. You got an EM guy. You can explore a lot of things over there. So why don't we go you first? Okay, Phil, and then you. Okay, you go first. Okay, you're first, then Phil. Yes.
A specific question for Tom. There's been a lot of media coverage that net leverage at triple Bs is higher than normal for triple Bs. Is that also the case in triple Cs, being more levered than triple Cs normally are? And then the second question for everyone on the panel would be, I've seen data that passive has risen to about 1/3 of the market share, if you will, in terms of AUM in the U.S. Where's the equilibrium? Is it going to keep rising? Are we at a peak? Where do you think we are in this cycle?
If you can use the microphone, Tom. First question.
Yeah. Chris, I'm not sure. I'm not sure about the actual leverage of triple Cs. There's been a great refinancing cycle, and that means cheap debt. And a lot of these companies have refinanced. I would think I mean, I'm just trying to reflect on it a little bit. I think leverage has risen, but I think interest cost has declined. So, you know, net, where is everything? It's probably in the middle. And I don't think we have any evidence that the market's about to collapse. But it all depends on whether we're facing a slowdown or a recession. If we're not, then everything will work out fine. If we are, then you'll have liquidity issues, and liquidity is the death knell of high yield, because then the companies can no longer borrow.
Excellent. Anyone have any thoughts about the equilibrium of passive investing? Is that a good way to kind of phrase it?
Yeah.
Okay. Anyone have any thoughts on that? I mean, we're in uncharted territory in that regard. Never before, right?
Yeah, I guess looking at it from the opposite side, I run into, when I'm speaking to people about emerging markets, there's a lot of market timing going on there, and people seem to be underweight. So to your earlier point, Sumit, about quality, the way to think, EM is sort of, if Wall Street begins as a terminus, if financial markets are a terminus beginning in Manhattan, EM is the last bus stop on this route. Mm-hmm. And when liquidity is withdrawn, that bus doesn't run out so far anymore. So if we're seeing people pulling money back into the U.S. and we're seeing problems in allocations in EM, either it's things are going so great in the U.S., which has been the case for a while, or it's also a possible sign of risk off.
Mm-hmm. Yes. Okay. Phil, you had a question.
Yes, I wanted to follow up on something that was touched upon earlier. And I think it was in the context of China, selling Treasury Bills or running them off. Is China moving away from the U.S. dollar? We have all of these dramatic things happening internationally with megalomaniacs, trying upon the stage in Shakespearean terms. Is it full of sound and fury, signifying nothing? Or did they actually expect people are going to start putting their currency in their assets into Russian rubles, or into Indonesia, or into Istanbul?
Definitely not Istanbul. Just gets it.
Any views on that?
I'm not an expert in this topic, but I'll tell you what I know and understand, which is it's the same theme of flight to safety. And so US dollar, of course, is the safest asset, and hence the dollar has been going up. Like, that's probably as simple as that. I know that China was trying to increase the value of the currency because they need that strength to do a lot of things in terms of, for example, building the Silk Road, the new Silk Road that they were trying to build. They're trying to finance all these projects and giving tremendous amount of money to a lot of these countries around the world. They needed their currency to be strong to be able to do that. I think this particular development in the last 1 year or so has put that to jeopardy. And so I don't know when that ends, but I think that at least for US, having that strength in dollar, I mean, I know it's not great from the currency from the export standpoint, but I think generally speaking, from a US consumer standpoint, it's still a very good thing, and our economy is driven by consumer. And so having a strong dollar actually helps consumer.
It appears that people buying gold are the central banks. That's how they diversify away from the dollar in particular, in currencies in general. And then, of course, there's the retail demand in India and China. You did hit upon sources of supply and demand for gold in U.S. dollars in the earlier presentation and discussion. How does that play out in terms of the charter of equilibrium that seemed to have been presented in the last year?
Yeah, the supply demand equation in gold right now, The major producers all have declining production over the next 3 to 5 years. A lot of the world's gold, easy gold has been mined out. But, if the price is high enough, you can get gold out of seawater. It's going to cost whatever, $5,000 an ounce, the supply's decreasing. The demand seems to be increasing too. I don't necessarily love to go here because you start going down, in a gold bug land, right? And then you lose all the credibility. But, the United States government, the deficit keeps increasing, spending trillions. The underlying economy is not supporting it. You got wacky things going on right now with the repo rate, right? That no one's even addressed. What did the Fed do today? That they announced they're going to, spend $100 billion. That's like not QE. And one of the major correlations is the Fed's balance sheet with gold. That'd be a good chart. If you line that up, there's a really strong correlation between the two. And, the Fed expanded their balance sheets back in, 2008, 2009, 2010. Gold went up basically every step of the way. And, they haven't been able to reduce it that much, right? And now they're embarking on a new, quantitative easing project, which is, I don't know, to me a little bit frightening. So.
Yeah, I just wanted to add Chinese, the CCP, Chinese Communist Party, the strategy in the trade war has been to devalue the RMB in the face of U.S. tariff hikes. So we've seen RMB go up over 7, and then what happens, that sort of spasm that we had in emerging markets in 2018, a lot of the currency weakness across the board, just idiosyncratic, poor governance in Argentina and Turkey. But in ASEAN, for example, if you're running if marginal cost of labor is cheaper outside of China, and that's why you're starting to see production go into these other countries, and then China devalues, then all of these countries then turn around and also devalue as well. So I think there's I think that's something you just have to be aware of investing in some of these markets, that the impact of the tit for tat of two economic superpowers duking it out is being reflected in any number of parts of the market, including dumping, diversifying their currency holdings.
Okay, let's go back there and then come to you. So, yes, sir.
This might be related to what Chris asked, but for Tom, there's an article in the Wall Street Journal about some very heavily vetted investment-grade bond companies that maybe should be downgraded, and some of the BBB minuses are trading with junk bond yields. Do you ever buy those, and do you have an opinion about some of those companies that they might become junk bonds?
I mean, there's been tremendous reach into the BBB and the BB market because people are searching for yield and they have to find it. Will some of those BBB companies become BBs? Yeah. I mean, it always happens whenever there's a sell-off or a correction. They will, and it's just going to be a normal consequence. Again, how quickly it happens, where it happens, that's all going to depend on economic circumstances. But it's normal. It's going to happen whenever there's a correction. And what are these things overbought? Probably, because people need to find yield somewhere.
Okay, question, yes, sir.
So, Paul, you had mentioned one of China's tools, if you will, is currency devaluation. I would imagine that would only exacerbate food price inflation on top of what they're already dealing with swine flu and some other factors causing a lot of domestic food price inflation. How close, if at all, do you feel like we are to civil unrest in China if food prices escalate so much?
That's a really interesting question. We could start talking some stocks too. ASF is kind of rolling through China. Massive consumer of pork. The global ramifications of this are, especially with the trade war, is Brazilian protein business is going gangbusters. If you want to see a stock chart on a flagpole, punch up JBS on your Bloomberg when you or on your phone. So Brazil is a huge grower of soybeans, and then that's a feed. And so a really interesting company to take a look at is WH Group. Trades out of Hong Kong. They own. I'm going to crucify my Mandarin is 0, but it's called Shenzhen Shanghui, and it's a massive pork producer that's owned by WH Group, and then they also bought. It's a very clever management team. They bought Smithfield Foods here in the U.S., which was Joe Luter's business. Back in the day, started, I think it's out of Virginia, just rolling up the pork business, and so the head of Smithfield is is a U.S. guy. He travels around with his Chinese retinue when they're doing their road shows, and he said in his southern twang, it was great. He said, if I could be reborn as a pork man, it would be in China. so I think food inflation is a big deal. I think that's why you're seeing, hey, we'll buy beans, and every time there's a risk off in the trade war, WH goes motoring because that's the import business. I think the problem of food supply, they have a strategic pork reserve and whatnot. So that's Hong Kong and civil unrest, I think, is a bigger issue than pork at the moment.
Mm-hmm. Anyone else have any questions?
Yeah,
Time for
just on the China trade war issue, I wouldn't underestimate the effects we're seeing in disruption at the supply chains, especially in third world countries or in just other outside the U.S. and China. We're involved in a paper company in Canada, which makes basically a type of fiber that comes out of paper. It's used in rayon eventually. And what we see is that worldwide, these dissolving pulp prices have collapsed. And they've collapsed because of the effect of these trade tensions on Chinese producers. So we're tending to think of the trade war in U.S.-China terms, but it's much more than that. It's affecting Canada, it's affecting industries all around the world, both positively and negatively. But especially, if it continues, it could cause a lot of pain and a lot of disruption in other countries as well.
Okay. Any final questions? Okay. Before we go to the closing comment, I do want to ask one other question, and it pertains to a conversation that I had earlier during the cocktail period in regards to a gentleman whose firm is predominantly in the fixed income area. And it was interesting in that that firm has moved more into some of the private equity type of opportunities and situations that are out there. In this particular case, it dealt with opportunity zones. And I thought it was really rather interesting. So my question goes to Sumit and then to Tom in regards to private equity. As part of this whole, reach for yield issue, you're in the private equity space, correct, Sumit? And so...
Absolutely. So the context for private equity is that it is a long-only vehicle. I think many people don't think about it that way. It's almost like a real estate, which is also a levered play, long only. And I've worked in private equity. The drivers of that business are low debt or low interest rates and availability of debt, which we have plenty. And so from that angle, the returns that private equity have shown in the last 10 years or so are phenomenal. But I think that people just need to have that context that of course in a rising economic environment with rates going down and with heavily levered balance sheets, yes, the equity is going to do great. But just don't lose sight of that context. I think that's probably the biggest, or the important thing is to understand that aspect.
Excellent. And Tom, any thoughts on that?
Yeah, I mean, we run across private equity sponsors all the time. About half of our companies, if not more, are owned by private equity sponsors. And it's absolutely true. The returns have been phenomenal. Private equity has been a great investment, but it's a great investment because what's the modus operandi of private equity firms? They buy a company that needs to be fixed a little bit. They lever it to the hilt, and then they get a return on the leverage. So it's not much different in many ways than what Garrett's talking about these gold miners or silver miners who are levering, except they're using leverage to get great returns when things work out. And when things don't work out, they shift these companies into bankruptcy and let the creditors handle them. So we look forward. Private equity should have great returns with private debt. There are tremendous opportunities as things are moving out of the public markets into private companies, either private equity or private debt being part of the capital structure. One thing I think we have to keep in mind all as citizens, and Bloomberg Magazine had an article on this probably about a month ago or 2 months ago, is private equity isn't necessarily the greatest vehicle for us as a society. And I'll just say that, if you look at the track record of private equity, it's been great for investors, for pension funds, for endowments, but especially for the private equity sponsors and for the managers. It's been less good for the companies that are the employees of people who are bought by these private equity companies. And what we're looking at is about 10 times the rate of bankruptcy versus public companies. We're talking about a lot of relocations and people finding themselves out of jobs, techniques used for pensions being cut off, et cetera. So private equity can be very good. It does yield great returns, but we also should think about the consequences as well as investors.
That's great. Excellent points there. Okay, closing comment from each of our panelists. I'll start with Garrett and work from the inside out this time. A thought. What would you like to leave everyone here with as your closing comment?
I don't know. I had the opportunity to give my presentation. We like to keep it simple, basically. Gold is a good diversifier within the portfolio. As I keep saying, when stocks and bonds don't do well, gold usually does well. So that 5% allocation, 10% allocation helps stabilize a portfolio, in times of uncertainty.
Okay, excellent. Tom, your closing comment, please.
I guess I'd say that if you look at credit or fixed income, there's relatively little value in high quality fixed income. It had investment grade had even a better year than high yield. It's up, I think, about 12% right now. That's unlikely to happen again, and there's huge risk it could go the other way. High yield, again, you're going to have to make a decision, and maybe you want to split your bets between high quality and lower quality. If you think the economy will do well, you should be in lower quality. If you think we're at risk, maybe you play it safe. I was reading an article by Ray Dalio a while ago, and he said we're in a long-term cycle where you should be looking at non-traditional assets. We're going to be in low interest rates for a long time and low inflation, and so that would suggest that you should be looking at commodities, and that might be a good place to be, at least for a part of your portfolio. And then I'd say again, you have to look at this divergence across equity markets, credit markets, wherever, by geography, by company size, but basically between where all the money's going, which is in these large issues, or in ETFs, and idiosyncratic strategies, and try to diversify through those and see where the best long-term value is. And I think there'll be a role, probably an increasing role for ETFs and passive strategies, just because of their convenience and their cost. But I think there also will be a large role for idiosyncratic strategies that can add value in the long term, especially as more assets go into the passive strategies.
Excellent. Paul?
Yeah, obviously, I'm an active manager, so I just maybe leave you with a few thoughts. If I'm looking at another investment, I always want to know what their edge is and why they think that's sustainable. So why do I think what I'm doing in EM is reasonable? What's my edge, and why do I think it'll keep working for a while? Boston Partners built up this three-circle process in the world's most competitive market. We've got $80 billion in the U.S., and we have a large cap value fund that keeps banging out good returns. So I kind of view our large cap value as the canary in the coal mine for our franchise. When we can't win on large cap value, that means the U.S. is hyper competitive, and that would be an issue. So that factor-based process, those three circles, we know that works globally. There's lots of academic literature about this. And so by being able to take that into emerging markets, which is far less efficient, the financial markets just don't have the things that, there's PE and venture money and all the things that we assume about the U.S. market just don't exist in many of these markets, or if they do exist, they're in a relatively nascent stage. So there's plenty of pockets to pick as an active equity investor. Most of those are people who are individual traders who are in the market, just as the Joes got smoked by the pros in the U.S. That's definitely what's happening in EM. And then in addition, we've put in a huge amount of money to build out the capacity to short an emerging market. So we have a really weird idiosyncratic stream of alpha. So I think it's hard to, it's a much less competitive market, and we've taken really an industrial blueprint from the U.S., from Las Vegas Sands, and dumped it into a satellite casino in Asia.
Very good. Okay, and Sumit, your closing comment.
We believe that it's a great time for us as long, short, active managers. All the distortions that we have talked about today, it creates amazing amount of opportunities that we have for both longs and shorts as the valuations go very disparate. And so we feel really good about the setup today, especially for our fund and the type of assets that we're doing. Alpha generation, we believe, is going to be phenomenal, and it's something that I would absolutely recommend.
Okay, terrific. And my closing comment is really pretty straightforward. All of our panelists, I think, did an absolutely fantastic job. Sumit provided some handout material here. You can explore a little bit further about his firm. Paul has an excellent, if you do a Google search on Paul, his name, an excellent article. I had to refresh his memory during the cocktail hours. Oh, I did that. Back on pension and investments. Really, really good piece. Try to find it. It's really well worth your time. It's not a very long read, but I thought it was very insightful. I thought it was an excellent piece there. Tom's firm, I get his emails on Concise all the time. Check out what he has to offer. Sumit has to catch a plane, by the way. Thank you so much. Tom's firm on Concise puts out material all the time, and you can check that out, and then what Garrett has to offer with all of his material here. With that, I just wanted to thank all of you for being here this evening. Every year, this is 16 years I've been doing this, and without fail, every single year, there is something unique that comes out of these discussions. And what Byron Ween said many years ago, it's not so much the predictions, but the process. And the process, I think, tonight, I hope you will agree, is something that's very productive to our work, which we need to do in regards to our clients in that regard. And so with that, I ask you to please all join me in thanking our panelists for an excellent discussion.